The trade desk, ticker symbol TTD. We're going to dissect its historic 40% crash, its fortress-like balance sheet, and its path forward. And, in the middle of this chaos, did a major high-profile tech investor just place a massive bet that this crash is a prime buying opportunity? Stick around to the very end, because I'll reveal exactly who it was and the move they made. First, let's set the stage. The trade desk, long considered the gold standard in digital advertising technology, saw its stock get vaporized. On August 8, 2025, shares plunged in a way the company hadn't seen since its IPO. To put this in perspective, the stock's 52-week high was a staggering $141.53. As of yesterday's close, August 14th, it sat at just $54.36. Its market value has been slashed to $26.6 billion. So, what on earth caused this epic collapse? It wasn't one thing. It was a perfect storm of negative catalysts hitting all at once. First was the guidance speed bump. Now, the second quarter numbers themselves weren't terrible. Revenue grew a respectable 19% to $694 million. The problem was the trend. That 19% was a slowdown from 25% growth in the first quarter. Worse, the company's forecast for the next quarter implies growth will slow even further, down into the mid-teens. For a stock that carries a premium valuation, even a hint of slowing growth can be a death sentence for its multiple. Second, the surprise CFO departure. Investors absolutely despise uncertainty. And having your chief financial officer, Laura Schenkein, abruptly exit on the same day as earnings is a massive red flag. It immediately raises questions and spooks the market, regardless of the qualifications of her replacement, Alex Kayal. The timing was simply toxic. Third, there's the ever-growing Amazon angst. Amazon's own ad business is a juggernaut, recently jumping 23% to a massive $15.7 billion in a single quarter. The legitimate fear is that major brands will increasingly funnel their ad budgets directly into Amazon's closed garden, where they have the holy grail of data, what you actually buy. This puts immense pressure on open internet players like The Trade Desk. And fourth, you have the macroeconomic overhang. Talk of tariffs and election year uncertainty makes big advertisers nervous. When they get nervous, they pull back on flexible near-term ad spending, which is the exact business The Trade Desk excels in. Combine these four factors, and you get the brutal math for a 40% haircut. For anyone new to the company, let's clarify what The Trade Desk actually does. It operates the world's leading independent demand-side platform, or DSP. In simple terms, think of it as a sophisticated, high-tech stock market for digital ads. Advertisers and their agencies log in, define their target audience, and TTD's software programmatically bids on ad space for them in real time across websites, mobile apps, and most importantly, connected TV. Its competitive moat is built on a few key pillars. Its primary product is an AI layer called Kokai, which automates and optimizes campaigns. It has OpenPath, which creates direct pipelines to publishers to cut out middleman fees. But its most critical weapon for the future is Unified ID 2.0, or UID2. This is an open-source identity solution designed to replace the third-party ad cookie, which is being phased out across the web by Google and Apple. Its adoption by major players like NBC Universal and even Amazon Publisher Services is critical for its long-term survival and growth. So, where will future growth come from? The primary engine remains connected TV. As viewers cut the cord on traditional cable, ad budgets are following them to streaming services like Disney Plus and Netflix, both of whom are now full partners with The Trade Desk. The second major driver is retail media. Over 30 major retailers, including giants like Walmart and Kroger, pipe their first-party purchase data into TTD's platform. This allows marketers to finally achieve closed-loop attribution, proving an ad led directly to a sale. Beyond that, international business, currently at 15% of spending, is accelerating, and the upcoming 2026 election cycle is expected to drive an incremental $300 million through the platform. Now for the financial health check. The picture is nuanced. The slowing revenue growth is the big worry. However, the underlying business model is incredibly profitable. Gross margins are elite. hovering above 80%, which is pure software scalability. Operating margin dipped slightly to 17.7% due to R&D spending, but the company remains a cash-generating machine. Free cash flow margin is a robust 34.7%. The balance sheet is a fortress, with $1.7 billion in cash, zero debt, and an active share buyback program that repurchased $261 million in stock last quarter. This brings us to the bull case. Why would an investor buy this dip? 1. You are buying the undisputed category leader in the open internet advertising space, a company with powerful network effects. 2. It's a cash cannon. That fortress balance sheet provides a massive safety net and the optionality to make strategic, growth-oriented acquisitions. 3. The secular shift of ad dollars from linear TV to streaming is a massive multi-year tailwind that is still in its early innings. TTD is perfectly positioned. 4. The valuation has been dramatically compressed. The 40% drop gives long-term investors a rare chance to enter at a valuation not seen since 2018. Of course, a wise investor must weigh the bear case. Why should you stay away? 1. The valuation, even after the crash, is still high. At roughly 60 times forward earnings, it's far from a traditional value stock. 2. The walled gardens of Amazon, Google, and Meta pose a massive existential threat. They could simply choose to starve the open internet of ad dollars. 3. Execution risk is now elevated. The combination of a guidance cut and a CFO change has dented management's credibility. Another miss would be punished severely. 4. The business is highly sensitive to the economy. Advertising is one of the first budgets to get slashed in a recession. Looking ahead, there are several key catalysts to watch for. The next earnings report in early November is number 1. A beat and raise there could spark a huge relief rally. Also, watch for news from the CTV upfront season, where advertisers lock in their budgets for 2026. And any major new adoption milestones for their UID2 technology would be a significant positive. So, here is an actionable playbook from an advisor's perspective. For portfolio sizing, treat the trade desk as a high-growth, high-volatility satellite position, not a core holding. Limit it to 2 to 3% of your portfolio. Consider accumulating shares in stages, especially at levels under $60. But you must have a long time horizon of 3 to 5 years to let the thesis play out. And be prepared for more gut-wrenching swings. This is not a stock for the faint of heart. The bottom line is this. The trade desk has shifted from being priced for perfection to being in prove-it territory. If you believe in the future of the open internet and its ability to compete with the tech giants, this crash could be the entry point you've been waiting for. But if you fear the walled gardens will ultimately consume everything, then you should stay on the sidelines. Now, to answer the question I asked at the very beginning, in the face of this chaos, did a major, high-profile tech investor step in and start buying the dip? The answer is a resounding yes. On August 12th, just days after the crash, Cathie Wood's ARK Innovation ETF bought 450,000 shares of the trade desk. It's a significant vote of confidence from one of the market's most prominent growth investors. That is the critical intel you need to make your next move.